Welcome to the Become Sensible podcast, where we discuss practical accounting, finance, and tax for everyday business. I'm your host, Fiona, and I'm here to show you that no matter what your business financial situation is, you can change it. Good morning and welcome to the podcast Become Sensible. Today, we talk about a very important topic that many business owners not pay attention on or no one actually explained to them why it's so important. That is the owner equity. And today we will talk about what is owner equity, why it's so important, what is it consists of, and what is the best practice that you can pay attention on owner equity. And so whether you a single member LLC or you run a business for someone else or you run a partnership or is this a C corporation and S corporation, I'm sure this topic today will be super helpful for you. So let's dive in. Let's talk about why it's so important to understand about owner equity. So what is owner equity? Owner equity is basically the owner's stake in the business. That is the leftover after the assets minus the liability on the balance sheet. It just shows how much that money and your stake in the business. And why is it so important? Number one is measure your ownership value. Equity represent your ownership stake in the business. Is so how much in the business is worth to the owner after you pay all the obligation in terms of debt and credit. And number two is talk about financial health. Whenever we look at the owner equity, if over time the equities increase, that just show your business is increase in terms of growth and the health. And I would explain for you what is actually consists of the owner equity, and that's help us to understand why over time it indicates a lot in terms of the business growth. Number three, because it indicates the business growth, is attract potential investor and lender. If you have the equity substantially drop, decrease over time, this is raise a red flag for the potential investor or lender when they look at into your balance sheet. Number four is help with tracking the business growth. So when you're monitoring the equity change over time, you track that your business is growing. Increasing equities is correlate to the business success and expansion. Number five is help with exit planning. So if you consider many business owners eventually want to sell the business in the future, when you look into the equity, you can plan, okay, what is your worth, your strong equity position in the business, and how do you potentially plan in terms of negotiation for your exit plan. So this is very important. Some of the business owners never want to sell the business. That is totally different. But if you are the type of the business owner that you start a business, and you want eventually you sell the business, this is where you actually need to take a look in your exit plan. Number six, provide the financial cushion. So if you have a very strong equity position, it's help you to stand on when the hard time come, because it's give you the choice, the option in terms of whether you expand the business, or you just stay hold on when the economy is stop going on. Number seven is will help you to guide on the distribution plan. So if you listen to my episode about owner distribution, you will understand that this depends a lot on your equity position in the business. If you have a negative equity in the business and you plan to distribution, that's further down the road is affect your balances and your equity. And eventually there's nothing left for you to actually make the distribution plan. So this is like correlate together between like the distribution plan and the owner equity. So once you look at in it, you can plan for your ownership like distribution like every single month, a quarter, or over the year. The next one is help you with in terms of like tax planning. I believe like in the distribution episode, I talk about if you distribute more than your basic in the business, which is the equity, but in tax term, they call it the basic in the business. If you distribute more than your basic in the business, especially for S corporation, it will have a tax consequences for you. So just make sure that you take a look into like the equity part of it, which is your basis, and have a plan for your distribution line accordingly. So it's not going to be like affects in terms of tax situation for you. Next one is measure your return on investment. So return on investment is one of the things that you always calculate, compare with your initial investment in the business, and over time, how much is your equity position. And that will help you to measure, okay, whether you actually have a return on investment into this business that you started. And then the next one is help you with financial analysis. So balances play a huge role in like financial ratio. There's so many things on the balances. We'll go into the financial analysis, and this will be like super helpful in terms like business valuation. If you consider like sell your business, raise fund, get a loan, there's a lot of financial ratio will be like going on with your profit and loss and your balance sheet. And that is why an equity part of it will be like plays a lot of role in financial analysis. And one of them is return on the equity that we will go into the analysis. And then finally is support for strategic planning. If you have a very strong equities, have the decision of like expansions or diversification or consolidation. So that's just why, even though not many people mention a lot about the equity, what is its value, and how it's play a role in your overall financial health, I want to emphasize that it's actually very important, especially if you want to expand your business and have it like grow business. And I mean, like, it's not any problem if you don't plan to grow your business, not expansion. You want to be where you are at for the rest of your like business career, that is fine. But if you actually plan to grow, to raise fund, to have a like financing and other thing, look at into your equity is actually very important thing. So now we talk about what is the components of a owner equity. So normally it has like owner investment, number one. Number two, owner distribution. Number three is retained earning. Number four is current year net income. And that's create the net ending equity. So after that, all of that four bars is ending like owner equity at the end of four of them. So there's one thing I want to make the difference between owner investment and paying capital. And people normally use the word paying capital is very confusing. But what is actually paying capital, especially if you have a C corporation? So when in the C corporation, when you start a business, you basically like issue the stock, like 500 stock or like 1,000 stock or something like that to start the business, and you pay in the money. That's like $1,000 or $100,000, whatever. It's like 10,000 to buy, to exchange for that, the first 1,000 or 10,000 stock. So that is called paying capital. It's not owner investment. That's just the money that you put it in and exchange for the stock in the business that you founded. And then the owner investment is the money that you put in from your personal fund, and it's not a loan to be repaid, and it's rather like a fund to invest into the business, and it's not to exchange for the stock in the business. So that is make it also like different from loan. owner loan and from the Bain Capital. Number two, we talk about owner distribution. And this is like I talk a lot about this on the episode about like owner distribution. And you should, if you need more clarity in terms of how to do owner distribution, listens more on that part. So owner distribution is basically like beside that you pay for yourself a regular salary, especially in like partnership, S corporation, and C corporation. After you pay yourself some salary, then the thing that's left over is like how much that I can get distribution to take care for other things in my life. And because there is the role between, especially in S corporation, there is the role in terms of like tax planning is how much that you pay for yourself because it need to meet the requirement in terms of like reasonable salary. And then the part of like need to have a money to carry on your personal financial responsibility. So that different part, normally that is where people put it in, is called owner distribution. And then it's also need to be like have a clarity between like owner distribution for like personal responsibility and owner distribution for tax. So normally like single member LLC and S corporation, they don't pay tax on these S corporation on the federal level, so that they normally like pay tax on their personal tax return on the Form 1040. And so because of that, the business also like distribution for them some money to carry the part of like tax situation. And so that's also categorized under owner distribution. So it will be super helpful if you can categorize one is like owner personal expense distribution, and the second one is owner distribution for tax. Number three, we talk about retained earning. And this one is super confusing for many business. Like many business owners like call me when they look at the balance sheet and they ask me, Fiona, can we just get rid of the retained earnings? Why is it so confusing to have a return earnings? So what is return earnings? Return earnings is the carry forward from previous year. So for example, last year, if you make $100,000 and your distribution now $50,000 for yourself, the leftover is 50,000. That will be carried forward into this new year, and it's called that retained earning. So it's mean like the money left amount after every single year you pay for distribution for yourself, and after pay all the expense and distribution for yourself, that's called retained earning, and it rolled over year after year on the balance sheet. So the more that you have a retained earnings, the better, because that have increased your equity situation. And so that's why owner distribution also play an important role in it. But that's make up the retained earning. That having minor distribution give you the idea how much your business grow financially since its inception. Because even your business make the profit, but the distribution to you is so much more than the profits of the business, then the retained earning become a negative number. So then number four is current year net income. You remember on the episode about profit and loss. So you have on top is revenue, and then all the expense at the bottom is called net income. So anything that net income on this current year, it will roll over and it show up on the equity on the balance sheet. And this is why I want to like remind again, profit and loss and balance sheets, there is a tight relationship between of this. And this is why so many business owners and bookkeepers don't have a basic fundamental understanding about accounting. They do the profit and loss on a Excel spreadsheet, but when they make the balance sheet, they couldn't, because they don't understand that these two actually tie together. So if you have a net income on the profit and loss, you need to have a net income on the balance sheet, and it sits under equity. And so finally, we talk about like what is the best practice to record the owner equity. Number one is like you need to like clear label and separate like different type of distribution. So if this is for distribution for owner expense, make it different, and the distribution for owner tax make it a different light for it, code it different, because that is help you to like, you don't need to memorize, don't need to check the detailed transaction. You can see it on the financial report that how much is it for the tax but already take care. Number two, and I see this happen all the time on the errors, on the mistake. That is, they don't close out the equity account at the end of the year. And this is requires a little bit like accounting, like experience and strong fundamental accounting to do it too. Because if you don't clear out all the distribution and it's rolled over, balance sheet item always roll over to the year after that. But all of the distribution accounts should be like clear out. But if you don't zero it out, like for example, this year your distribution for you or distribute for yourself is 50,000. If you don't clear this out into the next year, if you distribute another 50,000, it will show up on the balances is your distribution is $100,000. There's so many of our new client would say like, I didn't get distribution $100,000 this year at all. So there's something wrong with it. The wrong part is because your bookkeeper or your accountant didn't close this and zero out the all the distribution part. And finally is make sure, and I don't know whether you actually like can remember it, but make sure that pay attention into the equity and make sure that your professional accountant and bookkeeper CPA actually take care of this like closing out. And I know it's like request a business owner to actually remind a bookkeeper, an accountant to like to do this. It's like seem to be the opposite thing. But I can say to you that I see this mistake like very often. For example, let's say your business have a net income $200,000. During the year, you get $100,000 regular owner distribution, and then you also get like $32,000 tax distribution. So totally, you got distribution is $132,000. So to close out, they actually need to make sure that they book it into the equity part that there's a zero out of your distribution 130,000. So then the beginning of the years, the beginning balance of your owner distribution will be zero. If in Jan, if like the January 1st, if it's still like have a 132,000, that's definitely is wrong. And why this is wrong is it will make you very confusing in terms of planning your distribution is number one. Number two is will make your equity account so it's not correctly reflect the real number that was happening. And then like all the analysis after that is also like not correct at all. This is why some of the business like have the balances is huge of negative number on the equities like hundred of $1,000 and they don't actually understand what is the reason at all. So this matters because it gives you a clear picture of your distribution. It's clear the confusion of why there's large distribution number year over year. And it's also give you like how quick access to like how much you already taken care so far in the business, and it make your returning features relevant to your current assets, because on the balance is always like assets and then liability and then equity. But if the distribution is not closing out, it will make your return earnings not relative relevant to your current asset situation at all. So in conclusion, understanding your and manage your own equity is very important to make sure it's clear and accurate financial report. By implement these practices, it will help you like grab a situation understanding about your business financial health, and it's better equip you to make the financial decision. As the business owners, end of the day, financial information is to help you to make the decision. You most of the time not the person actually book this transaction, but end of the day, you need this information to help you make better financial decision. So if everything is still confusing with you, make sure that you talk to like a experienced CPA or like let us know if you have any question. Thank you so much for your time today, and I cannot wait to see you in the next couple episodes.